Okay, it's 10 o'clock. We are going to get started today. We have a lot of content for our presenter to get to. So hopefully most of you are warm and dry wherever you are. I know Rob Ellis, who's here with us today, is sitting smugly in Florida, where he's not facing any snow, sleet, or rain or freezing temperatures. So he's very lucky. But thanks for everyone being here today. As you know, today's presentation is focused on the NCUA's Fair Lending examination procedures, and it will be presented by Rob Ellis from Spillane Consulting. So John Spillane and his team have been working with MSIC for many years. So when John and Rob reached out to let me know that the NCUA had recently announced that fair lending practices are now a supervisory priority, I knew it was reliable information and that our membership would really benefit from being looped in and prepared for what's ahead. A little background about Spillane: since 1991. Spillane Consulting has taken on a hands-on approach, helping a variety of organizations in the finance industry with strategy creation, plan execution, coaching, and reinforcement. The team at Spillane Consulting is world-class. They have years of experience, a wealth of knowledge, and an unwavering commitment to their clients. Robert Ellis today is with us. From Spillane. He's our presenter, and he's a senior compliance consultant with over 30 years of experience within the banking and lending industries. He's going to share a bit about himself, so I won't say much more than that, except that he has an awesome presentation prepared for us today. And that as far as format, he does welcome questions during the presentation. So don't be shy. You can send them in the chat box to either Rob or myself. You can raise your hand and I can unmute you so you can speak to Rob. It's whatever your preference is. And then we also do have time set aside following his presentation, a little bit of a Q&A session. And with that, Rob, thank you so much for being here today. I'm going to turn off my mic. I'm going to give you the stage and have a great time.
Great. Thank you, Erica. Good morning, everyone. It is my pleasure to be presenting today. My name is Robert Ellis. As Erica said, I work for Spillane Consulting, and I hope today's presentation gives you some good tools to ponder when you go back and review your fair lending program in order to be prepared for your next NCUA's exam. Just to give you a little background on myself, I started in the industry in 1992 with the Mass Division of Banks as an examiner. So I had gone around to quite a few different credit unions in my tenure at the Division of Banks, and I have a familiarity with the credit union and its charter and membership. So I am familiar with that. And I spent 11 years at the DOB. I also have been a compliance director at a couple of banks in the $7 and $8 billion range. I've also worked at the FDIC, and the past 3 years, I've been working at Spillane, and I do things from simple, very focused reviews to completely running a CMS program for institutions, and everything in between. But enough about me. Let's get on with today's presentation, which is about the NCUA's 2024 supervisory priorities and surrounding fair lending and affordable housing. And on today's agenda, I am going to be covering 5 main topics. Number one, what are the priorities, and what have they been saying? What's out in the public eye in regards to what their focus is concerning fair lending and what they're saying? And with that said, the second agenda item is going to be, well, what are the exam procedures? How do they go about doing their examinations? So you have a familiarity of how they go about determining fair lending risk and whether or not discrimination occurs. Third bullet point is going to be about what your data is telling examiners. HMDA data is critically important, and I'm going to get into how important it is to make sure not only it's accurate, but that you're looking at it, because you're sending that to the government and you're telling the government, this is our story, this is how we lend. So it's important that we get into that so you understand HMDA data and its importance. Fourth, in preparation for the fair lending exam, I'm going to go into just some elements that should be in place to have a satisfactory exam. It's high level, but you need to have these points covered in some way, shape, or form in order for to satisfactorily get through an exam. And lastly, I think it's useful to go through recent Department of Justice cases, as well as the most recent Navy Federal Credit Union lawsuit, And what's interesting from that is the clear pattern that comes out of these enforcement actions. So it's eye-opening. And I want to reiterate again what Erica said. I like it when there are questions asked. So at any point, if you have a question, you want me to go over something, please, I would like this to be interactive. Don't wait, don't hesitate. And even though there are at the end, there's question and answers. If you feel you want to raise your hand, please go ahead. And Erica, if you don't mind making sure that you keep an eye on that, because I may not even know where a question's coming from. So, all right, let's get started. What has the NCUA been saying about their priorities so far for 2024? And it started in January with their credit union letter talking about what their focus is and their strategic priorities for 2024. And of course, number one and number two is credit risk and liquidity risk. But number three was consumer protection, specifically in the area of fair lending. And in it, they talked about examiners going to be evaluating credit unions' policies and procedures and their practices for redlining, marketing, and pricing discrimination risk factors. So that goes above and beyond your typical underwriting discrimination risk. So that was the first thing. The next thing is in February, Chairman Harper was at a Brookings Institute seminar where he talked about the credit union's regulatory agenda for 2024. And he made it a point to talk about fair lending as a priority of the NCUA's exams. Specifically, he talked about the exams will increase in number and focus. And I'm going to come back to focus in a little bit. But the point is that the chairman wanted to ensure that credit unions' policies and practices are fair and not discriminatory. So again, policies and practices reiterated, and going back to the first credit union lender. So examiners are going to be asking for policies, procedures around your fair lending program. So you need to be prepared that they're going to be asking around that, not for you to tell them, but show them. Make sure it's documented. And thirdly, you had the NCUA strategic plan, which came out a couple of years ago, but their priority number 1.3 has to do with fair lending. And again, it talks about ensure compliance with federal consumer protection laws, but it also had a bullet point talking about targeted consumer compliance reviews and fair lending exams. So that's an interesting comment, targeted. And it goes back to what Chairman Harper talked about fair lending focus. So something that sometimes happens is you have a focal point and you have an outlier where the government will identify credit unions or depository institutions where their HMDA data really exceeds the norms. And you could be notified that you are getting a specific fair lending exam focused just on that. Now, I have not heard of any credit unions that have received any of these letters, but I have definitely been a part of other lenders that have received these types of focused examinations. So those are the things that are in the, shall we say, in the public. They're on the NCUA's website. They're easy to find. But also, from a standpoint of Spillane, we have heard from some of our partners that during the exams, the NCUA has been very focused on fair lending practices. And for those credit unions that don't have all the aspects I'm going to talk about later, they're putting in matters requiring board attention. Fair lending monitoring and fair lending programs are part of their exam findings. So they are not just saying it, they're doing it. Any questions about priorities before I move on? Just throw it out there. All right, as well as fair lending, what also goes hand in hand is the NCUA has put a focus on affordable housing in 2024. And as it said, it identified a need for inclusion based on disparities experienced by minority, underserved, and underbanked populations. So what they're saying, and this isn't just an NCUA thing, this is from Washington. This is the FDIC, the Federal Reserve, the OCC, the CFPB. As a matter of fact, the FDIC Chairman Greenberg, I just got a notice this morning he was talking about inclusion. Now the FDIC is going to put that as a focus in their coming exams. So as the NCUA has stated as a goal, it intends to enhance consumer access to affordable, fair, and federally insured financial products and services by meeting the needs of underserved, diverse communities. So what is all this saying? What do the examiners expect? So what they're going to look for is, do you offer products and services that meet the needs of all your members? underserved members, underserved communities, and they're going to ask if you have affordable housing products or affordable housing programs. And it is critical that you have some type of analysis where you've reached out to, could be an affordable housing agency, and connect with them on what are some of the needs of these underserved communities. Now, you may not have success, you may not have thousands of applications or even a couple applications, but you at least need to demonstrate to the NCUA that this is a priority of ours. We've done outreach, we've done analysis, we see the segments we're not reaching. We're trying to figure out what can we provide, what services or what can we provide to reach those underserved communities. It might just be something like financial education, first-time homebuyer seminars, something to inform your members about these things that aren't getting home loans. So again, it isn't so much the NCUA's expectations are that you're hitting home runs all the time. It's that you are making the effort to understand the needs and making sure that your products and services are available to all those different communities. Any question on that? And I know that affordable housing is definitely something that right now is, and I've actually worked with a couple of our Spillane's clients in trying to develop affordable housing programs. And really right now, the way rates have gone up, the way median home prices are, it's nearly impossible to come up with affordable housing program because it's just not realistic. When you look at what the target audience is, which is a low to moderate income applicant, and that is 80% of median family income, what they can afford considering the rates, when you put together a principal and interest payment, they can maybe afford a $300,000 loan, maybe $350,000. And if you got median home values at $500,000 or $450,000 in some of these communities, it honestly, it makes no sense to put all that time and effort to create an affordable housing program that no one's going to qualify for. So you need to be involved in mass housing or FHA or something that you can offer your customers. Any questions about some of the NCUA priorities? Okay, so we've seen that, we've heard that. They're going to have fair lending as a priority and making sure that your products are reaching all segments of your communities and your members. So what are the exam procedures? And I want to state that the exam procedures aren't just the NCUA's, it's actually the interagency exam procedures. It's something all the FDIC, the OCC, the Federal Reserve, they all agree this is how we go about scoping fair lending exams. And for the most part, it's a two-part process. The first part, which is critically important, is the pre-exam stage, where the examiners are gathering as much information about the credit union as possible. Things like policies, procedures, things like marketing, things like training, things like complaints, and they assess all that along with your data, your HMDA data, and they try to identify risk factors. And they take each area like underwriting, pricing, marketing, redlining, steering, and the federal agencies have identified certain risk factors. For example, if you have very low application rates to a certain primitive basis group, let's just take like Hispanic. Let's say you have like a 3% application rate. In your area as it's defined, other lenders get 8 or 9%. So that's a disparity. Now, it doesn't mean that you're redlining, but it's just a risk factor. And it starts the examiner to have to consider, okay, well, what could be the reason for this? And is it really how significant a disparity? And when the examiner puts all the risk factors together, if he has or she has, let's say, multiple risk factors in underwriting, then what they do is they determine a focal point. And during the exam, they will focus on, and it could be a specific product, it could be a specific type of area, and they will come in and look at that and do a deep dive on that specific product and try and explain away reasonably why those fair lending risk factors were present. And the first thing they do when they come in is they will ask you about your fair lending program, and they're going to see, okay, did your program identify the same things the examiners found? And if so, if it was the focal point, then they're going to ask, okay, well, how did you respond to it? Did you treat it as a real risk, or did you explain it? Was it reasonable? Was there an action plan? So they're going to do a deep dive in regards to what you did in determining whether or not the risk was there, what you did about it, and how you corrected it. Now, if there is no fair lending program and you're not aware of it, well, then the exam can really, that's when the examiners start to dictate and start to make you do things, as well as determine their own opinion as to why the risk factors are there. So, and that could result in, again, types of things that require board attention and exam findings and costly results. And I also want to be sure that we understand what the definition of discrimination is, because, you know, you can have all the policies and you can say, we lend everywhere, we do not discriminate, we don't treat anyone differently. But there are actually three different levels of what the agencies consider as discrimination, the NCUA. There's overt discrimination, and that would be, that's what you think, like, oh, we don't lend to Brockton, we don't lend to Worcester, we don't, whatever it may be. That's an overt statement that has a correlation to a prohibited basis. But there's also such a thing as disparate treatment and disparate impact. What those are is basically, it's a policy or practice that on its face is completely neutral to any prohibited basis group. However, when you look at the data, again, going back to HMDA data, it has a propensity to have a disparate impact or a negative impact on a prohibited group. So that in itself can be discrimination. It can be nothing intentional, but just by the practice itself harms a prohibited basis group, you have discrimination. Things like redlining. Redlining is discrimination. So those are the exam procedures in a nutshell. It all is based on risk factors. Any question on NCUA exam procedures? All right. Moving along.
Rob, a question did just come in about error in recording required HDMA data. What happens if you have an unintentional error in submitting the data?
Errors in submitting the HMDA data?
Yes.
Well, what they'll do is, and that is a big part of the examination, is determining that your HMDA data is accurate, because they base a lot of that fair lending analysis off that data, so it has to be very accurate. What they'll require you to do is scrub your data. They'll do what's called a data validation review before the exam, and if they identify certain data points as inaccurate, then they will require you to scrub your entire LAR to find, okay, what other loans were in error, and then you have to refile your LAR. Another thing about HMDA that is one of the few laws that actually have written into it required civil money penalties if a pattern or practice of violations is found. So not only can it be costly to have to scrub your LAR, which is go over every single loan, compare it to the LAR data points, correct it, and refile, but they could possibly cite civil money penalties if they feel that the reason for the errors was a result of a CMS, a compliance management system failure. So yeah, HMDA data it's accurate on many different, it's important on many different fronts. I hope I answered the question. And I'll get into, the next slide is coincidentally HMDA.
You did,
So,
yep, correct, thanks.
And I do want to stress the importance of HMDA. So I just mentioned how it's critically important that you get it accurate, because when they do a data integrity review, and they'll take a sample of your LAR. And the procedures state that, okay, if in the first 30 files of your yearly LAR, there's 1 or 2 errors, then that will get a pass. You're allowed a very small amount of errors. And if you exceed that, well, then they exceed their sample. And then at that, there's a whole table of, depending on your LAR size, what the initial sample is. But at the end of the day, you only get like 2 or 3 errors. And there could be up to 110 data points per application. So the accuracy requirements is really strict. So it's important to have a very thorough HMDA data verification and validation process. But on top of that, you need to also be analyzing your data. You need to have some type of review of what your data is saying. And this doesn't necessarily mean it needs to have like NASA sponsored. It doesn't have to be sophisticated. Boy, I can't speak today. Doesn't have to be sophisticated, but you at least have to look at your numbers and know, okay, what is our application rate to the different primitive basis groups? What is our denial rates to males versus females, maybe individuals over 62, Blacks, Asians, Hispanic? What is our fallout rate? At Spillane, actually, we have a tool that is very high level, but at least can identify and start with, okay, are there any sort of red flags just on the surface of HMDA data, not even carving down to product specific or even just open end or closed end. So, and in the HMDA data for the exam purposes, as I state here, there are 15 different risk factors that can be identified in the HMDA data. And underwriting has the most. In underwriting, it's typically the origination, denial rate, also your kind of fallout rate, your processing times. That can indicate something that is discriminatory in itself as well. Pricing is another big fair lending focal point where you look at rate spreads could trigger a fair lending review. If you're definitely not denying, let's say, Hispanic or Black borrowers. However, they statistically are getting higher rates, more than your control group, which is your white applicants. So pricing is a big focal point, and steering, redlining, and marketing as well. And I think redlining and marketing are two very, very hot topics just in the past year. And we'll get into that when I get into some of the DOJ enforcement actions. But HMDA data is very important that you're not just making sure it's accurate, but someone is looking at it from a standpoint of either once a year or once every couple of years, and just what is this HMDA data saying? Because this is what you're telling the examiners. You're telling the government, this is our story. This is how we lend to our members in our community. And you're going to want to know if there are discrepancies or disparities and have that already on an action plan, which says, we saw that too. We went and looked at, if it's like underwriting, what the loan policy wasn't specific enough, wasn't detailed enough. So we changed it. We did training to underwriters. We also did we did a little more on the exception and override process, lowering the amount per month. Like we used to have 25%, we lowered it to 5%. Those are the type of things that will lower fair lending risk after identifying a disparity. So things like that are important that from the HMDA data, that you are taking action on any of these disparities that are found. And I can't stress that enough. Any questions on HMDA data or its analysis? All right, well, maybe everyone's waiting to the end. All right, so here are some 7 bullet points that I feel are definitely necessary in order just to get a passing grade on your examination. And I say a pass on the examination is that you have these elements present, they're documented, and they're in practice. And number 1, I want to repeat again, data analysis. You should have some form of data analysis in your fair lending program. It should be documented. That you look at your HMDA data, you might look at if you are a commercial lender, your small business data, could be consumer loans. Anything that you have data on that you can review is going to be a positive for the examination. Secondly, that kind of goes hand in hand with data analysis, but is different, is you have fair lending monitoring. And that is the technical, that'll be reviewing technical aspects of either a COA or the Fair Housing Act or Fair Credit Reporting Act. So you periodically, you don't have to be every year, but at least once every other year, you take a sample for compliance with the technical aspects of ECOA, making sure adverse action notices are accurate, they're timely, and that the FCRA requirements are being met. So you have a monitoring program for those technical aspects of fair lending. Also, number 3, critical, is you should have an annual fair lending risk assessment. And this typically would mirror when you go back to what I said about the interagency exam procedures. This really mirrors that pre-exam stage of identifying all the risk factors. This risk assessment, its goal should be identify those risk factors and gauge them. How much of risk are they? And do they need to have some type of controls or corrective action put in place? So your risk assessment would feed into a fair lending action plan where you can have those items, and also you need to be able to monitor and track if your corrective action was effective. Number 4, you should have an up-to-date policies and procedures process. Having old, stale policies that don't get reviewed elevates fair lending risk. I mean, it literally is in the exam procedures for underwriting risk factors that are, if there are policies that are vague, have a lot of discretion, don't get updated frequently, don't get reviewed, it's a risk factor. It's something that gets identified as a weakness in your fair lending program. So make sure that policies and procedures are regularly updated, reviewed, and by someone in compliance, and also someone has a fair lending review on them. So you make sure your lending policy doesn't inadvertently state something that might be overtly discriminatory. So they should get a review, and then anytime there's a change, that change should get updated and get passed by the eyes of a compliance person. Number 5, which is critically important, is that you are doing fair lending training to every single employee. And it doesn't matter, it doesn't just limit it to lending personnel. Certainly lending personnel need probably the most fair lending training, but fair lending training should be of every employee of the bank, from HR to tellers to the board. Everyone needs to get fair lending training to understand how their role could impact possible disparate treatment or treating different people inadvertently. 6, which is critically important, is the consumer complaint response program should definitely be highlighted, in that if any member questions or claims they were discriminated against, that complaint gets escalated. The complaint gets reviewed, and doubly reviewed, by a senior manager and a compliance person, in that the response is thoroughly penned so that members, all their accusations get addressed. Because this is something that me as a former examiner, if they were fair lending complaints, especially when I worked at the FDIC, it escalated awareness in the FDIC as to, well, what's going on? And it's a note in the exam. So when the next exam occurs, you see this institution had fair lending complaints against it. It heightens the awareness to do that fair lending scoping, and might cause for the focal point to occur a little more heightened. So it's important your complaint response, and hopefully you never get a discriminatory complaint, but you should already have in writing the practice of what will occur if someone does claim discrimination. And then lastly, a fair lending committee. Now, depending on your size and structure, maybe a committee isn't necessary, but what this represents more so is a central location where all these 6 prior things are located and they're documented, so that if there is a committee, you can see on the agenda that data was talked about, that there was scoping talked about, or what the next monitoring review should be. The risk assessment is read out and discussed. Policy procedures that might have some type of fair lending implication get discussed, or at least documented that the following procedures were updated and there were no fair lending concerns. So this is a great place to document for examiners how you go about doing your fair lending program. It's what I call the hub. It's where everything comes in, and you can show how you take fair lending seriously. And those are the basic bullet points of, when you go back to your credit union, what state of each one of these do you have, and able to produce to an examiner to say, this is our program, these are elements, and you have an overarching fair lending policy that contains these points and how you go about it. Any questions on fair lending program elements? Okay. All right, next up, I want to get into some of the recent enforcement activities in this Navy Federal Credit Union discrimination lawsuit. So it sort of started back late last year where CNN actually did a news report about Navy Federal Credit Union, and they highlighted how Black applicants were more than twice as likely to get denied versus white applicants. And apparently CNN said that even when they have similar incomes, property values, and neighborhood characteristics. So I didn't exactly see how they did their data, but they made that claim. And then also shortly thereafter, Fairfax County, which is in Virginia, this FFX News, they did a story and they highlighted how the origination rates to Blacks is way lower than white applicants. And so what you've got is basically the Black applicants are the target group and the white applicants are the control group. And as I mentioned before, one of the number one underwriting risk factors is disparities among approval denial rates for applicants by monitored prohibited basis characteristic. So it elevated the fair lending risk. It was reported by CNN in this Fairfax County FFX News. And next thing you know, they have a lawsuit citing that they discriminate against Black applicants. Now, this, of course, nothing was reported on. They just report on Navy Federal Credit Union's rates. But a key thing that you look at when you're looking at your denial rates is what are peers and what are aggregate lenders denying at as well? Because the simple fact of the matter is, in Virginia, I actually have recently did some data analysis. And unfortunately, Black applicants, based on just aggregate lending data, are denied 1.9 times more than white applicants. So to say Navy Federal Credit Union denied Black applicants 2 times as much as white, that's actually expected. That's a normal type of rate in the industry. Now, it's still a disparity, so you have to go in and look at, well, we have disparity, but when we look at the Black denials, were they all definitely not qualified? Another aspect that is critically important is you don't just stop there. Let's say, oh, all the Black denials, they were all legit. You need to look at white approvals, and were there any less qualified white applicants that got a loan? If that's the case, then yes, now you have some danger, because you have definite disparate treatment. You had a white, less qualified individual approved compared to a Black denied that was more qualified. That's something needs to get on an action plan and explained as far as, okay, it was vague, why did it occur, and that corrective action changed underwriting, did training, whatever it is. And depending on how severe that difference was, you might actually should consider reaching out to that denied applicant because there was consumer harm there and offer them. You could say, during review, it was inadvertently found that we denied you. Are you still looking for credit? I mean, that's a subject for a whole other conversation, but that's sort of like how when you start pulling the thread off of some of these disparities, what you need to do to figure out, okay, we're good or no, we're not good. But that's part of things that when looking at the data, the HMDA data, and the HMDA data bore this out. Next up is going to be these Department of Justice fair lending cases. And this, again, it is striking how similar all these cases are. And I just took the last 5, but I think 10 of the last 12 were all about redlining. And you can see redlining, 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 redlining. This is a big item with the DOJ and with the agencies. And like I said before, the NCUA is going to be focusing on this in 2024, looking at data. And all these cases are extremely similar, and they all have the same profile. Number one, they all had low application rates compared to peers. in minority areas, what's called majority census tracts. So their data from HMDA, again, HMDA, was low. Secondly, they typically did not have any brick and mortar. They didn't have any branches in minority census tracts. That's the second thing they all had in common. Not only that, but some, I'm sorry, I don't know if I just got a question or not.
You
But
did.
another thing,
I was just giving you a chance to break. Do you want me to interrupt with it?
yes, please,
Yeah.
if definitely,
Yep. So when it comes to consumer lending and offering loans to non-resident alien borrowers, is it a fair lending violation if we limit the loan term to not exceed the visa expiration?
that's an excellent question. Um, ECOA does allow if you can to consider the, I mean, this is really, really convoluted. ECOA allows creditors to consider residency status, like permanent residency status in underwriting. That is allowable. So if their visa is to run out and they want to have a home loan, that is something to consider. Now, the twist that has recently come up is some states are going as far as, and California is one of them. Massachusetts is not one as of right now, but some states are saying that it is illegal to make a decision based on someone's immigration status. Believe it or not, they can even be an illegal immigrant or undocumented, or whatever you want to call it. You can't deny them based on that fact alone. So this is a very hot topic, but ECO, the federal statute, and the state of Massachusetts does allow you to consider that situation. And if you feel the risk is too high because they won't be in this country, then that is acceptable. I hope I answered the question.
I don't see a follow-up, so I will let you know if anyone else cuts in.
Okay. So back to the DOJ and this redlining. So again, they all had very similar profiles. Come to data, they didn't lend in these communities. They had no branches. As a matter of fact, they closed branches in minority areas. Thirdly, they did no outreach, no marketing in these areas whatsoever. As a matter of fact, they sometimes skipped over these areas into other geographies. So they had targeted marketing campaigns. And then lastly, they went as far as looked at loan officer sort of demographic information. And many of these, all the loan officers were white. And they literally, in some of these, they would cite that that was evidence of discrimination. So the HMDA data, the branch networking, marketing, and loan officer composition, all of these had those similar profiles, and they were charged with redlining and had these enforcement actions. So, I mean, it's a difficult thing, but again, it goes back to monitoring and knowing, okay, in our area, if you're a community credit union and you have a whole bunch of cities and towns, in those cities and towns, if there are census tracts that are minority areas, are you lending in those areas? If you're not, the next step would be, okay, well, there are things to sort of like explain away. Okay, what are other lenders? What are the other lenders' rates there? You know, if you're at 1-2%, if other lenders, all the aggregators are at 1-2%, it's like, oh, well, we're not that far off. Why we're not lending there? And then you look at that's because there's very little owner occupancy rates there. So it's extremely difficult to get loans there. So, but again, first step is what's the data say? Next step is, okay, it's low. Is it reasonable to expect that number to be that way? Third, well, if it isn't, then what do we need to do? Okay, well, are we failing because we're not marketing? We don't have branches there. Again, it's sort of like the more no's you have on that fair lending type of risk assessment, the more you need to have that fair lending action plan that addresses, hey, we found our numbers when it comes to redlining and marketing, we're not satisfied with it. You never admit that, oh, it looks like from our data we redlined. No, it's just you feel you're going to do a better job, and this is what we're going to do. We're going to start with marketing. HR now has trying to get maybe a Spanish speaking person or someone of diversity, so forth and so on. We're looking into maybe opening a branch in this area. We're looking at locations. So at least when the examiners come in, number one, they see you've identified your risks. You're taking meaningful and corrective action to try and lower those risks. And you may not have the success yet, but at least your program is showing it's working. And that's the critical aspect when you're going to have an examination, that you can demonstrate that you're actively working your risks and trying to make them lower. And another interesting thing that I highlighted was back in November when they announced the Ameris Bank redlining case. Attorney General Merrick Garland, actually at that time, that's when they went over the $100 million mark for civil money penalty enforcement actions. So it was quite a landmark. But he did mention in that, buried way down to the end, that he mentioned that the Justice Department has over 24 investigations into redlining across the country currently. So again, it was January, February. I was somewhat surprised there wasn't an announcement in March, but I feel like any day now there's going to be another announcement of the next redlining case. So this is definitely very hot topic, and the NCUA are going to be coming in and asking those questions, and they're already going to know. They already have a scope. So if they're asking about redlining, you should know, oh, it's a focal point of their exam based on the exam procedures.
Rob, is a credit union's advertising program subject to scrutiny by the NCUA as far as fair lending?
Absolutely. Yes. Yep. They look at advertising. They look at if it's targeted to a certain, and again, the interesting thing about credit unions is you already have a charter where your membership is defined. So your marketing is going to already focus to that area. So you do get somewhat leeway. But again, in every single segment, there's a certain slice, shall we say, that is or could be a period basis group. And you definitely don't want to somehow inadvertently exclude that group in your marketing or even like strategic plan. Some of the dangers there are overstatements based on age that you want to be sure are covered, or other statements where we're going to focus on this geography. Anytime you say we are focusing on this, you want to be sure that, well, it doesn't mean we're not going to serve this. It's just this is our strategic plan to try and tackle these areas. So it gets complicated, but that's a very long answer to a very short answer, which is yes, they will. I mean, it's in the, I think it's the marketing risk factor literally says marketing, what is it? Marketing efforts are not representative of the demographics of their market area. So it is something that's looked at.
Rob, as far as a question just came in, as far as managing third party and indirect fair lending compliance, how can credit unions manage fair lending for third parties?
Well, I mean, it's better to talk specifics as far as what those third parties might do. Certainly, like when you talk about like appraisals, because that's a big thing. You have third party appraisers doing your collateral review, and appraisal bias has been a big item in the news. Some things you need to do as far as your vendor management is, number one, that you make sure that the appraisers or the company that you're getting the appraisers from, they make a statement in regards to fair lending is critical to us. The appraisers go through annual fair lending training. So the appraiser themselves has awareness to what fair lending is and that they need to be neutral on those terms. Secondly, with that being said, you've gotten their guarantee they adhere to fair lending, they do fair lending training. You need to have some type of monitoring of that vendor. And for appraisals, it's just simply, if you look at, again, it doesn't have to be a NASA driven type of thing. But if you look at, let's say, minority applications denied based on collateral, like LTV or something. All right, well, someone should look at the appraisal and look at, okay, was there anything in this that just on the normal, like just collateral use PAP is done anyway. But is there anything in there that might have indicated a bias, that they might have, maybe not treated this applicant's property fairly and equitably? So, and that the expectations from Washington are that you have that you're reviewing appraisals to make sure there's no bias in there, because if you read a lot of the stuff from Washington, they're convinced there is bias, there is appraisal bias, and that minority areas don't get valued the same way as non-minority areas. So for vendor management, yes, depending on the type of vendor, depending on their interaction with consumers, your members, yeah, I mean, there are definite things that need to be in place as part of your fair lending program. Okay. So I just in
Rob,
conclusion,
another question just came in.
okay.
If a credit union has a field of membership across multiple counties, but a concentration of branches and comparatively much longer legacy in a single county, is it fair to analyze the data on a county by county basis?
It might be. I think that, you still want to know overall, of the counties, let's say it's 3 counties. You want to know, I think, overall, what the demographic makeup of those 3 counties are, and know what your application rate is. Like, take, for instance, Hispanic. If in the 3 counties, the Hispanic population is 10%, you're going to want to know a couple things: what your application rate is and what other lenders' application rates are to Hispanics, as well as your peers, which could be other credit unions, could be other lenders that have 200% of your law and 50% of your law. You're just going to want to know that. You want to know that. And then you can dive down. It certainly doesn't hurt, but then you can dive down on the county basis. Okay, specific, you're getting more granular. And sometimes when you're really on the microscope level, you need to have that 10,000-foot view, because that's where the examiner is going to start from and start drilling down. But then it's also good to look at, okay, from a county level, and what's in this county specifically, because you could miss a risk by having such a high level review. So, and it could also be where your concentration of applications are coming from. And it could be, you could identify, could be some type of disparate treatment from loan officer to loan officer, where one loan officer does something different in one county where you have a much higher population of minorities compared to another loan officer in a non-minority concentrated type of county. So, yeah, I'm never going to say no to that question. Okay. We can, are there more questions? Or, I mean, certainly there's Q&A after I get done my little conclusion here.
Nothing right now.
All right, so I think in conclusion, the important thing is really have a fair lending program in place. And again, it needs to be something that is in writing and something you can give to the examiners, like pre-exam. So again, it's show me, don't tell me type of thing. And make sure it has all those aspects covered. And again, conduct data analysis. Really, you need to know what your HMDA data is saying, especially because there's so many different things from a fair lending point of view that can come out of HMDA data. And have an action plan. If you're doing analysis and you have a fair lending program, you're doing risk assessments, you're going to find things. And it's almost worse to have a program and do, well, actually it is worse. If you have a program and you're identifying risk and you're doing nothing about it, than if you had no program at all. So when you do identify a risk, put them on a documented action plan, again, like discussed at a compliance committee, where the reasonable steps were determined to try and correct what those deficiencies or what those risk factors identified. I mean, because yeah, the last thing you want is a lack of a plan when examiners are asking you about things, and that's not the first time you want to hear about it. You want to have the answers for the examiners before they ask the questions. Okay, well, I hope this was informative. I hope this was something that was useful, and maybe get your thinking caps on and go back and evaluate your own programs. And but are there any questions?
Yeah,
I'm
there
here
are
to
a
answer
couple
them.
more, Rob, that came in while you were speaking. Does a fair lending examination or offsite supervision contact affect a federal credit union's CAMEL or risk ratings?
It definitely can. It would be, I believe, in the management rating for the camels. If there are fair lending violations, that your camel rating should definitely be impacted.
Okay. And can a credit union dispute or appeal a fair lending exam or an offsite supervision contact?
Well, I mean, hopefully, during sort of the discovery aspect, you're having good open communication with the examiner, and that the examiner is being open and saying, I'm investigating you for redlining. And that they present, here's what I've got from my data, here's what I've got from my type of evidence I'm basing this on. I mean, I hope that you have that interaction, that you have the case that you can say, okay, well, you didn't look at this. Like, I know one instance is like for redlining. Let's say they have your HMDA data and you had 0 loans in, let's say, Brockton. I mean, just for a sake of a high concentration of minority census tracts. Well, you'd want to say to them, okay, yes, we saw that. We're doing more with our HMDA data, but we also look at our commercial loans. We have small business loans in these census tracts. We're lending there. You want to throw everything you can back at the examiner to defend yourself in that, no, we're not redlining. We apparently didn't, for a couple of years, we didn't get good home mortgage loans, but that's because of, for liquidity or a reason, you really weren't doing home loans. But you have other loans, you maybe have consumer loans or some auto loans or something, or you did outreach. Again, you go back to, you might have done some type of first-time homebuyer seminars, something that shows you did not avoid these census tracts. And that should take away their concern and lower it from now exam findings and possible enforcement action types of things. But once there's like a enforcement action for fair lending, yeah, I mean, there's not really a way to dispute that.
Okay. Anyone else have any other questions? Thanks for those that have been jumping in. We appreciate it.
Yeah, I
And
mean, and
Rob,
certainly anything.
just like for my own kind of, knowledge, what are some, if you're able to kind of on the spot do this, what are some myths that credit unions fall into regarding fair lending? I know sometimes, small credit unions think they might not be subject to, the disparate treatment because they're so small. Are there any other myths that credit unions, kind of fall into where it can be overlooking, the obvious?
Well, probably the hardest thing is, like I said, knowing I've been in credit unions, I know how much the members mean to credit unions. It's like
Yep.
the members and who they are and the importance credit unions have to serve those members. I think that I want to use my words carefully, that
Mhm.
they could never imagine discriminating against anyone. Like it's just, so I think the danger is sort of like feeling comfortable that this can't happen because
Right.
of just the way your charter is, the way you're set up. I think that it's a bit of a false sense of security, regardless of size, that it just won't happen here, and that can be dangerous
Yeah,
because,
absolutely.
I mean, every aspect of lending, every aspect of taking the application, aspect of even servicing loans, like back during PPP, or if you did type of forbearance. If you look at, like, if it just was a certain, like that control group, white people that got some type of benefit, and you have other segments that didn't get it, it can be discrimination. It can be even foreclosures. You did one foreclosure, it had to be a Hispanic, borrower, and there were other similar that you didn't foreclose on. That can be discrimination.
Right.
It's so every little thing can be turned into discriminatory conduct. Um, so yeah, I think the danger in sort of being complacent is could be that myth.
Yeah, and I think the other thing that we always hear within credit unions, especially with compliance, is that, having written policies and procedures is obviously a great thing. But it doesn't mean that it ends there. Risk management is such a big part of that. And, continual review, and not, like you just said, becoming complacent, because, just having the policies on file, training is important, employee training, cross training. So yes, absolutely.
Yeah, like you said, the policy procedures. I mean, how I said that stale, dated policy procedures is a risk factor, because the examiners are gonna, well, what is going on? Like,
Yep.
what is there any strict, like, bright line, for LTV, for DTI, for what is bad credit? If one underwriter thinks any 30 days of a credit card is bad, another underwriter says, I let a 30-day go. It's okay. Okay, well, then there's discretion. There is no bright line. From there, when they look at the data, it ties together. Okay, the lack of clear underwriting guidelines and their data resulted in underwriting being a fair lending focal point. So you want to avoid focal points.
Right.
So, and also with policy procedures, like you said, great written policy procedures. These things are updated all the time. But when you have a proper audit or monitoring plan go into effect, we looked at procedures. Like, part of when I do a risk assessment is I try and get procedures, and then I do interviews with the managers from each, like, processing, underwriting. And if I hear, well, how does that occur? And then I'm like hearing, that's not what I read last week, because that's what, me as a former examiner, that's what I do. I read what did you say you do, and then what you actually do.
Right.
Hopefully those two things are identical, but if they're not, it raises the risk factor. It raises the exam type of scrutiny. So it's important to have the procedures well written, updated, reviewed, but tested in monitoring as well. So, and again, that's risk management 101.
Right. Well, Rob, thank you so much. The presentation was awesome. I know that you are going to make your deck available. You are also available to answer questions. I can provide information to anyone to get in touch with Rob. And we will have a recording of this webinar up on our website probably by the end of the week, but I'll keep you all alerted. Rob, again, thank you so much for your time. Thanks for reaching out and letting me know about, the subject matter. I think this is of great interest to our credit unions. I know greatly appreciated, very relevant. So thank you for that.
Thank you.
Just to review with everyone, next week on Wednesday, we're going to have a governmental affairs update from Kearney, Donovan, and McGee. They're going to be talking about topics relevant to credit unions that are being focused on in Congress. And then we're going to talk about the impacts on credit unions with this upcoming election year. So that's next week on the 10th. The 24th, we'll be rebroadcasting a webinar from Feline, the evolution and impact of AI in credit unions. And then in May, we have two trainings scheduled, one on the 8th and one on the 22nd. And that one's for the NCUA's ISE program, and the other is for the NCUA's ACET program. So keep an eye out for my emails with more detailed information. I'm still scheduling webinars and presentations in through the summer, so you'll continue to receive information. And other than that, please do reach out if you think of any subjects that are relevant to your shop, to any of our credit unions. I'm happy to look into that and get something on the schedule. Thanks again for everyone being here. Be safe out there, stay warm. See you all next week. And Rob, again, thank you so much for being here with us today.
My pleasure. Thank you so much.
Take care. Bye-bye.
Bye-bye. Bye, everyone.